Hello, investors. This is Ted Zhang, Associate Portfolio Manager with Revere Asset Management. Today is Sunday, August 4th, 1:53 p.m., coming to you from Fort Lauderdale with this weekend's Revere Roundup weekend walkthrough. All right, well, I've been doing the videos for the past 3 days. Don has been sick, and then Connor has been at home for his birthday, his 23rd birthday. So I did the nightly video. I was on the podcast with Dan, and I gave him a pretty long commentary there. And I finished the last week off with my Friday nightly video. So if you haven't checked those out, I'd highly recommend it. Those are some of my thoughts on the current state of the market. For this weekend's video, I'm going to keep it relatively short. There isn't too much to talk about. I'll quickly go over what we normally go over, but it's pretty broad selling. So let's get right into it. The state of the market, protection gauge, market leaders are down, pretty much zero stock setups. The only strength, which I'll show later in this video, are defensive sectors and the aerospace defense as tensions in the Middle East are rising. Short term, below the 21 EMA on all major indexes. Um, Medium term, our intermediate trend gauge, pretty much a red era at this point. All major indexes except the small caps are below the 50, and the long-term moving average is still up, and we are still above lows. So long-term trend is still up, but that could come under pressure quite quickly as we see how fast these markets are nowadays. So let's quickly jump right into it. Starting off with the S&P 500, just broad selling, bearish reversal candle engulfing, followed by the gap down on the weak job numbers. We are seeing some of the highest volume in this sell-off so far. So perhaps we see some stopping volume. For example, on this week, this is the highest weekly selling volume since the bear market. So maybe my two thoughts are that one, we put in a short-term low here and then rally, and or this is just indicative of extremely weak action in the markets, in stocks, and this will lead to prolonged selling. And this is just the second wave down. Maybe we get a rally and then we head for a third and try to test the 150-day or maybe even the 200-day. RSP, just terrible action, new highs, weekly bearish engulfing on huge volume. Not a good sign at all. NASDAQ, tech has been under pressure and continues to stay under pressure. Same thing, bearish engulfing candle, followed by gap down below this previous breakout level on huge volume as well. That could be a harbinger for future weakness or maybe short-term capitulating action that leads to a bounce. But once again, there are no stock setups. So what I think the more probable outcome is a prolonged correction here. QQQE failed breakout, poked its head out into all-time highs and completely failed back in. Now below the 200-day and 40-week. Officially pretty much in a stage 4 decline now. Weak action there. Nothing's different from mid caps. Broke on all-time highs and now closed back in. Found support 30-week. Bearish engulfing on high volume. Not a good sign at all. Small cap, same thing. Bearish engulfing on the weekly on huge volume, more volume than the 3 weeks up. So this is a failed breakout once again. What a frustrating area in the markets, the small caps. The Dow, same thing, bearish engulfing on huge volume. This is definitely stronger than the other indexes, still above the 10-week and 50-day, but under pressure as well. VIX at one point was 50% up, almost hit 30. And I mean, volatility is apparent in the markets now. Pivot failures all over the place, base failures, stocks falling apart, little to no stocks are holding up. And so cash is definitely king here. I know some people who had really nice shorts on the semiconductor ETF, but only to give it back the day before on FOMC day, and then they saw their positions head straight back into profits. Shorting is a very hard game in itself. It inherently implies a lot of volatility, which means greater uncertainty and higher probability of being stopped out, since we're low risk entry traders. Big A index, pretty much similar action. back to these highs. Huge failure on the RG8, bearish engulfing, literally the worst breakout fail, some of the worst breakout failure characteristics you could possibly imagine. Close below the 150-day and 30-week. We are under severe pressure here. Now, here is where it gets quite concerning, as I've talked about on the past 3 videos I've been a part of. On the heels of the manufacturing data and the weak job numbers, with unemployment ticking up to 4.3%, and they expect and job numbers coming in much softer, much lower than expected. Bond market had some of the biggest moves in close to over a year. 1 year was down 27 basis points, 2 years down 26, 10 years down 18 basis points. And bonds saw huge bids. There's a clear flight to safety. Bond traders, bond investors are pricing and discounting a recession. High yield bonds, bearish engulfing as well. Failed breakout. Junk bonds, same thing. High yield and junk bonds are synonymous. This is not a good sign for risk on. Corporate bonds actually are very strong. So people are seeing corporate bonds as a flight to safety here. I mean, owning some Apple bonds or some Google or Amazon bonds who generate so much free cash flow, probably quite safe at this point. Dollar, huge move to the downside as well, following the yields. Gold, all-time high weekly close, but still a lot of volatility. This looks like it's off to the races though, and if gold, and since gold and bonds are more correlated now, that is a fear trade and not a good sign for the markets. Crude, huge move down. Same with gasoline, just supportive of the recessionary narrative. And I just want to remind you guys that when we talk about fundamentals and macro, we always want to corroborate that with the price action of what the market is actually doing, not what you think it will do. That's really important. So we try to find the stories in the macro and the fundamentals that support the prevailing dominant trend, and that is correction right now. Bitcoin crypto getting liquidated literally in a week. We are down 20% back to the lows of the base. These 53,000 level, this 52,500 level really has the hold, or this Bitcoin uptrend might be over. And that will really break historical cycles, because we had the halving in May. And about 3 to 5 months after is when we start seeing the big move in Bitcoin. And so if this holds up, this is a potential very constructive base in the making. And if we take out 72,000 level after the markets come out of a correction, it'll be on to the races. Let's see. Ethereum on the ETF, this is breaking the lows of the base. This looks like the uptrend is done for now. Just terrible action here. Really nothing else I could say. Heading on to some breadth, Pradeep Market Monitor, we have red across the board. Means strength is an absolute no-go. I mean, there's nothing to buy anyways. And the 5-day ratio is at 0.34, which is extremely weak action and a cautionary tale for sure. Also, when we get back-to-back 700 plus down days like this, so number of stocks down 4% plus in a day starts piling up, that indicates extremely weak action in underlying stocks in the market, and we should be on high watch and definitely defensive. Net lows across the board, not a good sign. We're barely eking out some net highs in this stock charts indicator, but NASDAQ, we're plunging into lower low in terms of net highs and lows. As you can see, net lows are expanding, net highs are contracting. NYSE NASI are pretty much advanced decline line derivative indicators. They've hooked down as well. NYSE crossed below the overbought territory, back below the 10-day moving average. MACD cross as well. So definitely not good action in breadth as well. This is interesting because we had that bearish breadth divergence that resolved itself while the index is pulled in and breadth exploded. But now breadth is converging with the price. Breadth is now coming back in, and we're seeing that price is coming in as well. Same with the NASDAQ. This looks like a failed breakout on breadth as well. So definitely weak action and something to take note of. CNN fear and greed briefly hit extreme fear, but we're in the greed. I mean, we're now back into fear. If you can see a prolonged, I guess, period in fear and definitely an extreme fear, then we could start potentially looking for those stock setups that are holding up, looking for a fall through day, and try to play for a new rally. Here's where emotions and this market is just so fast, and why you have to be so diligent and proactive in your risk management. Here's the September FOMC probabilities. Prior to this week, we were definitely going to get one rate cut, but there's almost 0% probability for a 50 basis point one. And now we have 80% probability of a 50 basis point rate cut in September. So just some drastic moves in these target rates as well as the bond market. Just some wild action. And volatility is definitely not a friend of a trend follower and a low risk trader. And so cash is king. I wanted to quickly bring in a heat map in DeepView. Shout out DeepView. Those guys over there are doing some amazing work. Let's talk about that before I go into some sector reviews, which is almost nothing. This is a heat map of the S&P 500. The figure in the boxes are percent change on the current week, and then the size of the box is weekly closing range. So as you can see, blue is green on the week, red is down. And what is green? Healthcare, financials, healthcare, more healthcare, utilities, consumer staples, real estate, all defensive sectors, aerospace and defense as well, with the Middle Eastern tensions rising and global geopolitics as well. And so the groups we traditionally traffic in that historically make the biggest moves and have clean trends that don't just mean revert and then fail are biomedical, tech, computers, consumer retail, leisure entertainment, and those are definitely took a hit this week. Tech, consumer discretionary, semis, materials. So definitely a time to definitely do less. If we go to sector performance review, once again, S&P 500. This is S&P 500 sector ETFs performance in the last 7 days. Defensive sectors are leading, as well as my sector ETFs. And we flip this around, pretty much it's just a broad selling. Bitcoin miners, uranium, semis, RK, 50 index, IPO, just broad selling. There's only maybe 10 to 15 ETFs green in my ETF watch list. So since there's not much to talk about in terms of sector moves, it's pretty much broad selling. I also did my scanning, and there wasn't really anything to look at in terms of stocks. I think it's definitely better to do less here. So let's quickly check out earnings. We have Berkshire before the open, and man, Warren Buffett is doing well. He sold 50% of his Apple position, raising close to $300 billion in cash. Berkshire is still up 20% year to date, while the S&P is up about 9%, and Qs are up about, I think, 11%. So he's completely outperforming. We have Palantir and Hims, Lucid after close Monday, Uber, Celsius before the open Tuesday, SMCI, Rivian, Airbnb, Reddit, GCT, Amgen after the close Tuesday, Shopify before the open Wednesday, Robinhood, APP, SRPT, Bros after the close Wednesday, Lilly, VST, Datadog, NVAX before the open Thursday, SoundHound, Elf, Unity are some after the close Thursday, and then pretty much nothing too notable for Friday. In terms of economic data, very quiet week. You have services PMI and ISM services, which will give us more of a picture on the economy. I mean, after we saw manufacturing, the labor market, I assume these to come in negative, and that'll probably cause more fear in the markets. U.S. trade deficit as well, consumer credit, and then initial jobless claims. So we'll see what happens this week. Still a big earnings week, not so much in economic data, and we're seeing broad distribution and selling. All right, so I guess that's it from me this weekend. That's going to wrap it. As always, we would like to hear from you. My email is ted@revereasset.com. You can also reach out to Dan and Don at revereasset.com. Our phone is 855 Real Wealth, and that is 855-732-5932. You can also hit me up on Twitter. I'm usually in my DMs, so I'll be able to reply to you, especially if you say you're from the videos, or you can just email me. That's probably easier in terms of client relationships. And just another reminder, we named our flagship portfolio GROTECTION, and that is exactly what we're doing. We're focused on the protection part right now, and we're doing so far so good. And once we get the right signals, stock setups, we'll re-engage back in the markets and get back to focusing on growing. But remember, it's not about how much you make in the markets. It's all about how much you can keep. Once you keep your gains after a healthy uptrend, you're able to compound from a higher asset base. And that is our goal for our clients. If you're interested in becoming one of my clients, please reach out to me. I'd be happy to talk to you about what I do and about what Revere does as well. This is Ted Zhang with Revere Asset Management, telling it like it is. Today is Sunday, August 4th. And thanks for listening. Have a great weekend. Have a great week. Manage risk. And I'll see you next weekend. And Connor will be back as well.